Welcome to today's explainer. Look, if you've been doing the responsible thing and putting money into a savings account every month, maybe $100 here, $200 there, you should honestly feel great about that. It takes real discipline and financial maturity to build that habit. But if you've ever looked at that growing balance and felt this creeping suspicion that you should be doing something more with it, well, you are absolutely right. Today, we're looking at the bigger picture. We're going to figure out how to safely and intelligently bridge the gap between just hoarding your cash and actually growing it. Okay, let's dive right in. Here is our roadmap for today. First, the savings trap. Second, saving versus investing. Third, the step-by-step path. Fourth, the power of consistency. And finally, surviving market crashes. Part 1. The savings trap. Why good habits aren't enough. Picture this scenario for a second. You've diligently saved up 10 grand. It's sitting right there in your banking app, safe and sound. But then you look at the interest rate and you realize it's earning something like a demoralizing 0.5%. Let's just do the math on that. After an entire year of locking up $10,000, you've made $50. Congratulations, you can almost afford what? Dinner for two at a mid-tier restaurant? No way. Listen, saving alone is an absolutely essential first stage, but it is a terrible final destination. You see, saving and investing actually have two completely different jobs. On the one hand, savings act as a vault. Its one and only job is to protect your money. But investments act as fertilizer. Their job is to actively grow your money. If you only ever play defense, you're going to completely miss out on building real wealth. Moving on to section 2, saving versus investing, the math of compounding. Now, what's really interesting here is the sheer scale of the wealth gap that opens up when we look at the numbers. Let's track that same $10,000 over a 20-year period. A typical 1% savings account, that grows to roughly $12,200. But the S&P 500 has historically returned about 10% per year on average over long periods. So compounded, your $10,000 becomes an astonishing $67,000. That is an undeniable $54,800 gap, created purely by compounding. The biggest wealth gap out there isn't between savers and spenders, it's between savers and investors. But here's the rub, right? Most people never actually make that transition. And it's not because they can't understand the math, it's because of psychology. Psychology is the real hurdle here. Your savings account feels wonderfully, perfectly secure. You can check it every single day, and it never fluctuates. But investing? Well, investing feels emotionally volatile. Seeing your hard-earned money drop 5% on a random Tuesday afternoon? Yeah, that is exactly what terrifies most savers and keeps them far, far away from the stock market. Validating that fear is the very first step to actually overcoming it. Section 3, the step-by-step path, a stress-free transition. So how do we make this transition stress-free? Well, before you invest a single dollar, you need to build a real emergency fund. We're talking 3 to 6 months of living expenses saved in cash. And to be clear, this is not for jumping on hot stock tips. It is strictly for surprise car repairs or sudden medical bills. People constantly panic sell their investments at a loss simply because they needed cash too soon. This buffer protects your future investments from your own everyday life. Next up is a really crucial psychological trick. You've got to mentally separate your cash into 2 different buckets. In one bucket, you have your safety money. This is your emergency fund. It doesn't move, and its sole purpose is to just stop your financial anxiety. In the other bucket, you have your growth money. This is the money you actually invest. You have to mentally allow this bucket to fluctuate because its entire job is to move and grow over time. Actually making this mental separation, it dramatically reduces the stress of investing. All right, once your mindset is dialed in, just start small. You don't need thousands of dollars to begin. 50 or $100 is plenty to build the habit. And honestly, the habit matters far more than timing. And crucially, please hear me on this. Avoid the noise. Beginners so often jump straight into day trading or high-risk crypto speculation. Ignore that temptation entirely. Instead, use the absolute ultimate beginner tool, index funds. Rather than trying to guess a few winning companies, an index fund just tracks the overall market. This gives you instant diversification across hundreds of companies all at once. That naturally lowers your risk while positioning you perfectly for long-term growth. It's boring, sure, but it is incredibly effective. And hey, if you're feeling any anxiety about keeping things that simple, just consider this. Warren Buffett, literally one of the most legendary billionaire investors in history, has repeatedly recommended boring, low-cost index funds for most investors. You don't need to outsmart the market with complicated trading strategies to build real wealth. Section 4. The power of consistency. Boring but brilliant. And this brilliantly illustrates what boring but brilliant actually looks like in action. Let's say you invest just $300 a month at an average 8% return. After 25 years, you have roughly $285,000. But check out the breakdown here. Only $90,000 actually came out of your pocket. The massive remaining slice, nearly $195,000, is pure compound investment growth. That is the reward for just staying consistent. To really wrap our heads around this, think of this visceral metaphor. Saving money is a lot like storing seeds in a glass jar. Sure, yes, you are protecting them, but they are never, ever going to grow into anything. Investing, on the other hand, is like taking those seeds and planting them in the soil. At first, it looks messy. You don't see results immediately. It feels totally out of your control. But given time and consistency, those seeds grow into something vastly larger than what you started with. Section 5. Surviving market crashes. Thinking in decades. But what happens when the weather gets bad, right? Well, here is the counterintuitive truth you absolutely must remember. Consistent, long-term investors actually benefit from market downturns. I know, it sounds crazy, but a market drop simply means your monthly contribution is suddenly buying shares at a massive discount. When the market inevitably recovers, those discounted shares totally supercharge your returns. This is exactly why veterans don't panic. They think in decades, not days. So the crucial point here is that transforming from a cautious saver to a confident investor isn't about taking wild, crazy risks. It's about sequence. You build your emergency fund first. You mentally separate your safety cash from your growth cash. You start small with diversified index funds, and you just let compounding do the heavy lifting. If you take away absolutely nothing else from this explainer, let it be this. Saving money gives you stability, and you absolutely need that foundation, for sure. But investing gives you freedom. The earlier you can combine the safety of the vault with the growth of the soil, the more powerful your financial future becomes. We've looked at the math, we've broken down the psychology, and we've laid out the exact sequence. So I'm going to leave you with this final thought to consider regarding your own finances. Are you still just securely storing your seeds in a jar, or are you finally ready to plant them in the soil?